Welcome back to Your Average Investor. Today we're going to be talking about some ETFs that have hit the market relatively recent that claim to have anywhere from a 50% to a 115% dividend yield based on current prices. Now, we're going to dive into their prospectus and figure out why that yield probably is not sustainable long term, even though it sounds quite phenomenal. And these are the max yield ETFs. What they do is they have an option income strategy for different stock tickers like Tesla, Apple, NVDA, etc. And all they're doing is creating synthetic long covered call strategies in order to generate income. We'll go into their prospectus in just a minute. It's very similar to QYLD. The difference is instead of doing this for a basket of stocks like QQQ stocks, it's for only a single stock. So like TSLY is just for Tesla. And if you want to see what their payouts have looked like, this has been their annual dividend payout. So if you bought 1 year ago, so far you would have received dividends of $8.20. So let's just bookmark this real quick, right? We're going to go 1 year ago today. That would be May. Right about here, you'd have bought around $28 per share. You would have received $8 in dividends, and now the current price is $15. So, right, with your dividends, you would be at a loss of about $6 per share, unless you had been reinvesting those dividends the entire time and then letting them continue to grow that way, in which case you might actually be up. I could do the math and figure it out, but you might actually be up a little bit if you had done that, because you'd be receiving these dividend payments for the year, reinvesting it into the underlying, and then, of course, it'd be growing your dividend payment over time because you'd have more and more shares. That being said, why is it that these ETFs seem to always lose money? Well, the answer to that is they don't. We'll take a look at NVDA. Here's the NVDA options, right here, NVDY. This is max yield on NVIDIA, or NVIDIA. And you can see they just recently started paying dividends, and it has a purported forward-looking dividend yield of 115%, which of course is not going to happen. However, it's very tempting to go, oh my gosh, I missed out on the NVIDIA rally. What if I just get this NVIDIA option income strategy and get 100% dividend, or even if it goes down to 80% or 50%, I'd be fine with that. Well, again, as long as the stock price is moving up, and especially if it's moving up slowly and consistently without a lot of pain up to the up or downside, then these are excellent strategies to help juice some extra yield. The problem happens when you get a lot of up and down movement, and that's why you have something like the QQQ, right? So if I look at QQQ, generally very nice uptrend here. You can see, right, from several years ago, $84 up to 400. In fact, hit a new all-time high this morning in pre-market, so you'd be up like 500% or whatever, right? Huge gains over the last 10 or so years. But when you look at QYLD, and they've been operating for about 10 years now, they've had nothing but losses. And I'm talking, again, just the price of the stock. Of course, you'd be paid dividends this entire time, and if you dripped those dividends back in and continued to just put it in on a drip, you'd actually probably be up overall right now and receiving a good dividend, but you wouldn't be up nearly as much as if you had just bought and held QQQ, right? You'd be up about 500% on QQQ. I guess you'd maybe be up somewhere between 50 and 100% if you had continuously, so like say you put 10 grand in here, and every time you got a dividend, you just dripped it back in and bought more shares, and overall you'd probably be up about 100% right now. That's just my rough guess. And oh, look at that. The challenge account just filled our Domo contract. I've been sitting in that all day. So if you're following along on the challenge account now has one additional position. I decided as a little bit of a YOLO just to juice it because I had a few bucks left over. So I bought this Domo call that expires in 30 days, and it looks like I got filled at $5. So that's pretty dang exciting. We're going to see if that turns into anything good. Feel free to follow along with that or not. This, again, is not financial advice. Anyway, back to QYLD and all of these. My personal opinion, what I like to do is just work up to buying 100 shares of QQQ or SPY or whatever else have you, and then sell the covered calls yourself, because then you're not paying this 1% expense ratio. So QYLD, I forget what their expense ratio is. It may not be 1%. All of these ones is about a 1% expense ratio, meaning if you throw in 10K, they're going to charge you $100 for managing that. So, it may not be that big of a deal if you're getting a 50% dividend, but it doesn't mean that that 50% dividend is going to continue. Like, what happens if NVDA suddenly drops like 40% in price over the next month because of some crazy thing that happened in the stock market? Well, likely NVDY is going to have huge pain to the downside, and then as NVIDIA recovers, NVDY will not recover nearly as well. So that's the risk that you're going on here, is these individual baskets of stocks, unlike QQQ, this individual stock is going to be subject to wild price movements based on a single earnings report or a short report or something like that, right? So QQQ, you've got a bunch of stocks in there. SPY, you've got a bunch of stocks in there. Any one of them is going to impact the price of SPY a little bit, but not a lot. Whereas Tesla, one poor earnings report or one good earnings report could send the stock flying or falling pretty significantly and leave you in the dust. But let's just look at the prospectus so you can see how these work. This is how they're structuring it. It's a synthetic covered call strategy, which means they never buy the underlying shares of Tesla to sell covered calls on. Instead, what they're doing is they're buying a long-dated call and then selling short-dated calls against it. So as an example, what I might do if I were this fund is I might look to buy like this call 150 on Tesla right here. So it's, got some decent in the money, so I'd be buying this for $4,000. And then every 30 days, I would be selling a covered call against it. And so maybe I would sell, and maybe this doesn't make sense, right? Let's find something that actually makes sense. Let's say I bought this call 180, and then I sold this call 185 against it. And I could do that every single month, right? So over the course of 6 months, I'd be making $500 times 6, $3,000. This one's only costing me $2,000. So theoretically, I could get a net gain there of about $1,000 or a 50% gain. And those dividends that are being paid on TSLY come from the premium received when I'm selling these covered calls. But again, they're synthetic covered calls because I'm not actually buying the underlying shares of Tesla. Instead, I'm just buying a call and selling another call against it. And that is where they limit their upside potential, because if I'm buying a call 180 then selling a call 185, I'm naturally limiting myself to the upside potential between those two strikes of $500, right? If Tesla zooms up to $200 per share, well, now this contract here is in the money, and so even though I have a call 180, it caps my earning potential based on the fact that I've sold the call 185. And that's why you have the difference in the dates, right? If I buy a long-dated call option, I can sell these short-dated ones against it, saying, hey, there's it's much more likely that this call 185 expires out of the money if I think the stock's going to go up than the call 180 6 months out, right? 6 months is just way more time for price appreciation. So say this one expires worthless and Tesla moves up to like 182 per share. Well, then the next month I would just bump my price up and sell like a call 190 and say, 195 the month after. And that's how you would continue to manage that risk. Now, the other thing that they do, which is very interesting, is they sell, so they have their synthetic longs, they write covered calls, and then they also hold short-term U.S. Treasuries as collateral in conjunction with the fund's synthetic covered call strategy. So what this means is because they don't own the underlying asset, they're just buying and selling these naked calls and puts, and they do mention selling some naked puts, they use the collateral in the treasuries as a way to fund that in the case that they got exercised and had to take on shares or something like that. And in addition to that, if they never need that, then of course they're just making a little bit of extra money on the interest on those treasuries. So they're very interesting. And if you look at all of them, they've got incredibly high, the distribution rate would be the what you'd call the dividend yield, 54%, 55%. Here's one a little lower with Apple at 23%. NVIDIA, they're toting it at 53%. Of course, that's QQQ. Right here, they show 115% because they just recently started paying dividends on it. And so this is assuming, what they're doing here is they're saying, assume that this continues for the whole year. You get paid $2.6 per share for every month for the rest of the year. That's what it would look like. But they do have one here. Look at this. Coinbase, they tote 18%. What was this one? CONY. So let's just look up CONY real quick. And let's see what their dividend history looks like. So here's CONY. And let's see where the dividend history is right here. Dividend history, look at that. 144%. They've been paying this one since October. So since October, it's like $1, $2, $3, $4, $5, $6, $7, $8, $9, $10, $11. You've got like $12 or so maybe like $24. And if you look at the price of CONY, let's look at CONY right now. It's going at about $23. So it's like, yeah, you're at $100 or 100% potential dividend yield. And this is a great example of where it works extraordinarily well, because if you look at Coinbase, oh, you know what? They've actually started growing over the last little bit. Coinbase for a long time, though, they were just pretty dang flat. Like if you look at this whole year, they had spikes up to 100, and they just moved between 50 and 100 over and over and over. So if you're selling covered calls during all of these rallies, you're making a lot of money. And that's where CONY probably did quite well. But now you can see, right, if you had bought back here, you're like, man, where's my gains? Coinbase has gone up significantly since then. I could have gotten in for $30 and been up like 700%. And CONY, I could have bought in at $20. Now I'm only up $3 or about, what is that, 15% or so. So those are the risks associated, but of course you're getting some good dividends. Up to you to decide what you want to do with this information. As for me, I don't like these. And the reason I don't like them is I can easily just sell covered calls myself. It's incredibly easy to sell covered calls. So if I find a stock that I like, why would I want to cap my upside potential by getting into one of these strategies here where I can't control when they sell the covered calls? I'd much rather say, hey, I love Tesla or I love Apple. Let me accumulate 100 shares for myself. And then as a Tesla investor or as an Apple investor, if I see, you know what, I think the price is looking a little peaky up here, I'm going to go ahead and sell some covered calls to protect myself, then I can do that. Sure, you're not going to get 50% dividend yields or 50% covered call return yields, I'll call it, I guess. But what you will get is you will get to participate in the fact that Apple over the last 10 years has gone from $22 a share to nearly $200 per share. Thanks for watching, everybody. Hope this was a good video. Please drop in the comments below anything you'd like to see. We'll catch you next time.